Leverage is a powerful investing tool, and understanding margin is critical for investors who want to take advantage of leveraged or option strategies as part of their portfolio. In this video, I'm going to cover what margin is, why you may want to consider using margin, the risks, and some of the basic rules about using margin. Trading on margin is basically borrowing money from your broker and using that money to make an investment. It's a powerful tool when used properly. Well, some people may question why anybody would want to trade on margin, so I'm going to share an example to explain why. Let's suppose you buy $5,000 worth of stock using cash. If the value of that stock goes up to $6,000 in 1 month, you've made $1,000 on your investment in 1 month. A $1,000 return on a $5,000 investment is 20% return. That's not bad. But what would your return have been if you had used margin? In a margin account, you could have bought $5,000 worth of stock using only $2,500 of your own money and borrowed the other $2,500 from your broker. If the value of that stock went up to $6,000 in 1 month, you would make $1,000 on your investment. A $1,000 return on a $2,500 investment is 40%. That alone explains why an investor may consider using margin. This simple example does leave out a couple of small details that are important to note. First of all, money's not free. If you trade on margin, you will have to pay interest on that money. Interest rates can vary, and you can find the current margin rate on the pricing and policies page. As an example, let's say that margin rates in our trade example we just went through were 8%. Well, since that's an annualized rate, your margin cost in our trade example would have been roughly $16.50. Margin rates can vary based on market conditions, and individual stocks may have different margin requirements. Always check to make sure you know your borrowing cost. Another thing to think about when trading on margin is that leverage can work both ways. In our example, if the stock had gone against us, the dollar loss would be the same whether it was a cash or a margin trade. But the percentage loss on your investment would be much higher on a margin position. If you bought $5,000 worth of stock using only $2,500 of your own money and then borrowed the other $2,500 from your broker, and the value of that stock went to $4,000 in 1 month, you would have lost $1,000 or 40% of your investment. Remember, leverage works both ways. To trade on margin, FINRA Rule 4210 requires that you have at least $2,000 in cash or marginable securities in your account. This is a FINRA rule, and brokers cannot make exceptions. FINRA also requires a minimum of $25,000 for day trading accounts. For more information on day trading, watch our videos on day trading rules specifically. There are a few other rules for using margin that have been established by the Federal Reserve Board, and these are known as Regulation T or Reg T. Two rules to be aware of are initial margin and maintenance margin. Initial margin is the minimum amount of money or manageable securities you must have to place a trade. The initial minimum requirement is 50%. In other words, if you want to purchase $5,000 worth of stock using margin, you must have at least $2,500 of cash or marginable securities in your account. After the position is established, you need to maintain a certain margin level in order to keep the position. FINRA requires at least 25% of the total value of the market security to be held in order to maintain the position. Depending on market conditions and individual security circumstances, margin maintenance requirements can be higher than 25%. Let's look at an example of what this is directly from the SEC website. Let's say you purchased $16,000 worth of securities by borrowing $8,000 from your firm and paying $8,000 in cash or securities. If the market value of the securities you purchased drops to $12,000, the equity in your account will fall to $4,000. If your firm has a 25% maintenance requirement, then you must have $3,000 in equity in your account, because 25% of $12,000 is $3,000. In this case, you do have enough equity because the $4,000 in equity in your account is greater than the $3,000 maintenance requirement. But if your firm has a maintenance requirement of 40%, you would not have enough equity. The firm would require you to have $4,800 in equity, because 40% of $12,000 is $4,800. Your $4,000 in equity is less than the firm's $4,800 maintenance requirement. As a result, the firm may issue you a margin call to deposit additional equity into your account, since the equity in your account has fallen $800 below the firm's maintenance requirement. A margin call is a requirement to either deposit additional funds or liquidate securities. Your broker will typically try to let you know if you need to deposit more funds and if you need to meet a margin call, but they are not obligated to. And your broker can liquidate securities in your account at any time if needed to satisfy margin requirements. You should monitor your portfolio closely if you're using margin. For option traders, having a margin account is required for all but the most basic option strategies. For options, margin means the amount of capital required to cover the risk of the strategy. For defined risk strategies, such as vertical spreads, this is pretty straightforward. A vertical debit spread requires the full debit amount to be covered. For a vertical credit spread, capital equal to the maximum risk less the net credit received must be in the account. For example, let's say you place a vertical spread with a $5 difference between the option strikes, and you received a credit of $2 per share to place the trade. The margin requirement is going to be $5 per share. The $2 credit received can be applied to that requirement, and so an additional $3 per share must be in the account to cover the risk in the trade. For undefined risk strategies, such as selling naked puts and calls, the rules are a bit more complex. For example, if you want to sell a naked put on a stock, the requirement for selling that option is 100% of the option proceeds plus 20% of the underlying stock price, less the amount out of the money, if any. Now, keep in mind that margin requirements on undefined risk option strategies may vary based on stock and market conditions, and they could be higher than the base requirements. You can see the requirements for option strategies on the pricing and policies page. Margin can be a powerful way to use leverage in your portfolio. But before using it, you should research and understand all the pros and cons, and then make the right decision for you.